Okay guys, so if you have been looking for a comprehensive beginner's guide that will teach you everything from A to Z to becoming a pro trader, then welcome to my channel. Now this video is for you if you have no trading experience or very little trading experience. The course is structured in a step-by-step manner, so please don't skip through. Otherwise, this will not make sense to you, especially if you are a beginner. So, I recommend you grab a notebook, take this step by step and make some notes, because the strategies and techniques that you will learn later to become a profitable trader are all based on this foundation. However, for experienced traders who will only visit for relevant topics, can use the timestamp in the description. Now, without burning much time, let's get rolling. So this part will be divided into 3 sections, all right? Okay, so let's start with section A. In this section, we will learn what is Forex. We will also look at the trading volume. We will look at the Forex market players, the market structure, exchange rates, advantages of Forex trading, what you need to trade Forex, what is traded in Forex, the currency symbols, major currencies, and then currency pairs. All right, so let's get to this. What is Forex? Now, Forex is short for foreign exchange, also known as the currency exchange market. Is the global decentralized market that allows the exchange of one currency for another. In short, buying and selling of foreign currencies. All right, so let's look at some examples of how people likely have participated in the Forex market. Remittances. So if you have been involved or participated in remittances, whether you are the sender or receiver, you have participated in the Forex market. For example, if you are to receive money from abroad, let's say the United States, and the money was sent in dollars, your bank here or receiving point will not give you the same dollars because dollar is not our official currency. So your money will be exchanged and then you will be paid in cedis. This way you have participated in the Forex market. Now, the second example is when traveling abroad. So you are going to another country for vacation or visit or whatever it is, right? And then when you get to that country and you start spending your local currency, look, they're going to look at you like some alien who just dropped. All right, but hey, you don't want to be an alien, so you want to go to the exchange booth and exchange your local currency to that country's currency, right? That country you are visiting's local currency. So if you have traveled, yes, you have participated in the Forex market by exchanging your currency to that country's currency. Okay, now cross-border business deals between companies. Companies that perform cross-border business deals have participated in the Forex market, in the sense that if, for example, the Apple company in the United States wants to buy parts from Japan, they send the money through bank. So they consult with the bank to facilitate the deal, and then the bank transfers the money to the manufacturer in Japan. However, the manufacturer in Japan will receive the money in the Japanese yen and not the United States dollar. So there's been an exchange at this point. Therefore, this is how companies who get involved in cross-border transaction or business deals participate in the Forex market. Now, the Forex market determines foreign exchange rate for every currency. The exchange rate is simply the ratio of one currency value against another currency. All right, so exchange rate fluctuates based on which currency is stronger at the moment. So in this example, euro dollar, the rate currently is 1.15504. This means that to acquire 1 euro, you need $1.15504 to acquire 1 euro. Now, exchange rate fluctuates based on which currency is stronger. So if the euro gains momentum, gains strength, the exchange rate will go up. Now, if the dollar gains strength, then the exchange rate will go down. It means that you need lesser dollars to acquire 1 euro. All right, so I'm going to explain this further moving on. So let's go. Now let's look at trading volume. So from this illustration, you can see that the Forex market looks huge compared to the 3 stock exchanges. So Forex is the largest financial market in the world with a global daily volume of about $6.6 trillion. Yes, that is huge. So even if you combine these 3 stock exchanges, it's still not even at half of the Forex market volume. Even that, the daily trading volume from retail traders only make up about 5 to 6%. Wow, 5 to 6% of the overall volume. And this is between about 300 to 400 billion dollars. Now let's look at the Forex market players. So this is the markets where the participants exchange or speculate on world currencies. And who are these guys? We have the super banks. Example is the Barclays Bank, Deutsche Bank, JP Morgan, Chase, the Citibank, and etc. We also have large commercial companies. I already cited an example on Apple trying to acquire parts from Japan, or some car company trying to deal with another company for maybe rubber or something to help them complete their production, right? So once it is a cross-border transaction, then the Forex market is in action. Government and central banks. So there's been cases where your government will want to intervene when their local currency is depreciating massively against other currencies by increasing supply on a particular currency. So for example, they can increase supply or demand for the dollar in your country, like it happens in Ghana, to help sustain the rate at which the currency is depreciating or appreciating. We'll be looking at this into details, so don't worry. Now, speculators. So speculators come in to try to make money, and let's look at the Forex structure to see who these speculators are. Okay, so we have the major banks in this structure, the major banks, medium size and small banks, all making up the banks in general. Then we have brokers, we have hedge funds, and then commercial companies. So all these guys are participating in the market. Now the hedge fund are either hedging some funds they are managing or speculating. So hedge fund also speculate. And then we have retail traders. Now some are just regular retail traders, like somebody who travel and then they have to exchange their money. They are not in for profit. However, we have retail traders who also speculate, like us, right? Speculate to try to make money from the moving Forex market, right? Now let's look at advantages of trading Forex. Advantages of Forex trading. There is low barrier to entry. Wow. Now there is free information out there all over the internet, like I'm giving you now. So it's gonna make it easy for you to become a pro trader by learning and then setting up an account. And this is not gonna be difficult. So there are entirely low barrier to entry of the Forex market. You just have to learn and then start trading. Less capital required. So you can start with as little as $100, unlike the futures and stock market. All right, in Forex you need very little amount of capital to start trading. High liquidity. So there is high liquidity in Forex that makes it easy to enter and exit a trade. With Forex trading, you can go in a trade and some 2 or 3 minutes or within a day you want to come out, because the market is definitely going to move if it's not a holiday, right? The Forex market is open 24 hours a day and 5 days a week. However, the stock market has fixed hours. So you realize that the Forex market is open and you have time to go in when you want to go in. So you can choose what time you want to participate in the Forex market, unlike the stock market that have fixed hours and then you have to be there once the market is open. You can use leverage to capitalize. However, leverage is a double-edged sword, so we will learn more about leverage also moving forward in this course. There's profit potential from rising and falling prices. This means that when the price is rising, which is market on an uptrend, you can make money by buying. Now, when the price is falling, you can make money by selling. All right, unlike the stock market where you will buy, and if it's going down means you're losing, but if it's going up is when you are making profit. But the Forex, whether it's going up or down, you can make the money. And the last one we're going to look at is very low transaction cost. To compare to stock and cryptos and futures, the Forex market has very low transaction cost. What you need to trade Forex. Let's look at some of the things you need to become a Forex trader. You need a computer, phone or tablet, and high-speed internet. Now, you don't need the latest iPhone or latest Android phone or the latest computer. All you need is a smartphone, okay? And then the focus should be on the internet. Because if your internet is very bad, it's going to be difficult for you to enjoy trading even after you are done learning and trying to put things into practice. You are going to find it difficult to fall in love with the whole process because the internet can be a major setback. So if you don't have a high-speed internet, then please get one as we are about to go on this journey. A trading platform. So there are quite some number of trading platforms, but as a beginner, you want to start with the MT4, MT5 because it's the most popular, easy to use, although it may look complicated because you are seeing it for the first time. But once you spend some time with it, you become familiar with it and then you will love to use it. So you want to start with MT4, MT5 because yes, it's easy to use and popular, and so far so good. That's what majority of traders are using. Now you need a reliable broker. Okay, so regards to brokers, there are thousands of brokers out there and you have to choose which broker to trade with. We will deal with brokers later in this course, so don't worry. I'm going to help you filter down how to choose a reliable broker. All right. You also need a trade journal. Now, trading journal is very important if you want to be able to learn from your own experience. One of the ways to learn is learning from your experience. And for you to learn from your own trading experience, you have to keep a trading journal. All right. That way, you can look back at what you did and see what you can improve on to become a better trader. This is why you need a trading journal, either on Excel sheet or you get a book, a notebook for this. All right. Now, trading strategy. Yeah, so trading strategy is very, very important. Trading strategy is simply a set of rules, right, that you will create. So you're going to create your own set of rules that you will follow to become a profitable trader. Now you have to be consistent with being disciplined and sticking to these rules. What are these rules? It's simply entry plan, trade management plan, risk management plan, and then exit plan. This makes up your trading strategy. I'm going to help you on how you can create your own Forex trading strategy. Now, capital. You need capital to trade Forex, but you have to be mindful of where the capital is coming from. Don't try to trade with your school fees. Don't try to trade with your rent. Don't try to trade with your hard-earned money, 100% of that. No. Risk what you can afford to lose. It doesn't mean you're going to play careless and lose the money. You have to treat Forex trading like a business. That is the only way you can become profitable. You're going to know how to do all this at the end. So let's keep going. Trading desk. Do you even need a trading desk? Well, I have a trading desk, but why do you need a trading desk? For me, I cannot carry my laptop or computer around, right? So I have space. I decide to get a trading desk. For you to decide whether you need a trading desk, be sure that you know what you're doing. The most important thing is knowing how to trade and not having a fancy trading desk. All right, unless you are becoming consistent and you are making money and then you want to create a little comfort for yourself, then you can do stuff like trading decks. So trading decks is optional. You don't really need a trading desk, but if you have the space and the funds, the means to be able to acquire a simple trading desk for a start, then that is fantastic. Now, office space. Wow. Do you need an office space? Well, it depends, right? As a beginner, you don't need an office space. You can start trading from your bedroom. Right, you can create a space in your bedroom where you can put your computer and start trading. But for a complete office space, that is that's on a different level. So that's going to be something else. Let's look at it this way. If you have your own house and you think you can dedicate one room to trading, that is fine. So that you probably want to have your peace of mind when you go there and you want to trade. right? But don't go and rent an office as a beginner. I know successful traders who still don't use office. I know successful traders who don't run office, who don't have office. You don't need an office because you are trading on your own funds, right? So who's coming to your office? But when you become profitable and you think you need that space, you need that you want to be comfortable, then that is fine. So office space to me is an X. You don't need it, all right? But that depends on you. If you have a big house and you want to dedicate one room to trading, why not? Good. Now, what is traded in Forex? So in other markets, like you go to the vegetable market, you buy vegetable, right? Now, when you trade on the stock market, you buy and sell stocks. Whereas in the currency market here, you buy and sell currency. So the simple answer is money. Money is traded in the Forex market. Let's look at it. So think of buying a currency like buying stocks of a company. All right. You are buying a stock of a company. That's buying currency. The price of the currency is usually a direct reflection of the market's opinion on the current and future health of its respective economy. Generally, the exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy compared to other countries' economies. Now let's look at the currency symbol. So we are trading money and then they are identified by their symbols. So here, currency symbols always have 3 letters, where the first 2 letters identify the name of the country and the third letter identifies the name of the country's currency. Very simple. In this example, we have the US dollar, which is represented by USD. Now, the US stands for United States, whereas D for dollar. All right. So moving forward, you realize that once you look at a currency symbol, you can easily associate it with a certain country by looking at the first 2 letters. However, it is different with Swiss franc, which is CHF. All right, good. Now, major currencies. So these currencies are called the majors because they are most widely traded. All right, they are the most widely traded ones. Looking at this list, we have the dollar, the euro, the yen, the Great British pound, the Swiss franc, the Canadian dollar, the Australian dollar, and then the New Zealand dollar. So these guys are like the most volatile currencies around the world, at least the top 8, or you can say the top 8 global economies, G8, right? Now they make up the major currencies. And here we have the symbol, the country, the currency, and then the nickname. So you want to know the nickname so you don't get lost in traders network when they are using the jargons, the terms, right? And you can hear a trader say, oh man, I was long on Aussie and guess what happened? It broke support and we've been bearish since. Whoa. If you're a new trader, I tell you, you don't understand what I'm saying. Tell me you do. So you know what, just take a pause and then take note of this table because you're gonna need it moving forward. Now, currency pairs. So in forex trading, currencies are traded in pairs. Okay, the currency pair is simply the measure of a currency's value against another. In every foreign exchange transaction, you are simultaneously buying one currency and selling another. So this is why currencies are traded in pairs. So looking at this euro dollar, we can see that euro is to the left and then the dollar is in the right. They are always listed in this way you are seeing them. It can never be dollar euro because it has been listed already as euro dollar. Here we'll be looking at the 3 groups of currency pairs, which is the major currency pairs. We have the minors or major crosses. So we have the minor currency pairs or major crosses. Then we have exotic currency pairs. So let's look at them. Now the major currencies. So from this illustration, you can see that these are the same major currencies we just talked about, paired against the dollar, and this makes them the major currency pairs. Simple. So major currency pairs are major currencies paired against the dollar. So all major currencies paired against the dollar gives us the major currencies. These pairs are most actively traded. Therefore, they have high volume and liquidity. Now, these pairs also have tighter spreads, and this gives us cheaper transaction fees. Okay, let's look at the minor or major crosses. Minor currency pairs, also known as major crosses, are the major currencies paired against each other excluding the dollar. Wow, major currencies paired against each other excluding the dollar. So from this example, we have 21 currency pairs, right? And these are the minor currency pairs because dollar is not in the pair. That should give you a clue what dollar is in the forex market. We will come to that next. All right, so we have the list of GBP pairs, Euro pairs, CAD pairs, Swiss franc pairs, Kiwi pairs, Aussie pairs, all of them mixed in this table, and then that gives you major crosses. Okay, now let's look at the exotic pairs. So exotic currency pairs are made up of one major currency paired with the currency of an emerging economy. We have Swedish krona in this example. We also have the Mexican pesos. We also have the South African rand, and then the Ghana cedi. The list can go on and on. However, these are few examples that we can talk about. These pairs aren't heavily traded as the majors or crosses, so the transaction costs associated with trading these pairs are usually bigger. As a beginner, you only want to focus on the majors. All right, to become a successful trader, you just have to focus on one or maximum two currency pairs. But if you do one pair, I tell you, that is going to teach you a lot of things. You're going to learn a lot from focusing on one currency pair, guys. Now let's look at the US dollar. So in fact, moving forward, we'll be doing currency profiles, and then we'll be learning about various currencies, right? But for now, let's look at the US dollar and see some of the things we have to understand about the dollar. So according to the International Monetary Fund, IMF, the United States dollar comprises roughly 62% of the world's official foreign exchange reserves, right? So almost every investor, business, and central bank pay attention to the dollar, and this is why in the forex market, dollar is king. Dollar is ruling. Now let's look at why. So why the US dollar plays a central role in the forex market. Number one, the United States economy is the largest economy in the world. Number two, the US dollar is the reserve currency of the world. The United States has the largest and most liquid financial market in the world. The United States has a stable political system. The United States is the world's sole military superpower. And then the US dollar is the medium of exchange for many cross-border transactions. So this is why I said earlier, you can exchange your local cedi to dollar before you go. Like if you're traveling from Africa to another country and you're not sure about if they are going to even accept your local currency. Yes, it does happen. So for example, if you are traveling from Ghana to what country? Let me not give any example, but there are some countries that when you visit, they might tell you we don't like your currency, and what are you going to do? So please, the best way to travel is to exchange your local currency to dollars before you move. And what are you going to do so you don't get stranded, right? Yeah. Okay, guys, here come the end of section A. Let's go for a quick break. Maybe you want to take some water, or you are pressed or something, and come back and continue section B. All right, welcome to section B. In this section, we will look at the Forex Quotes. How does Forex trading work? Forex trading sessions, the bid, ask, and spread, Pip and Pipette, leverage, lots, bulls and bears, Forex orders, and then brokers. All right, so let's go. Let's look at Forex Quotes. In every foreign exchange transaction, you are simultaneously buying one currency and selling another. The currency on the left is the base currency, and the currency on the right is the quote or counter currency. The base currency is the basis for the buy or sell. Now, when buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. In this example, you have to pay 1.35520 to buy 1 British pound. When selling, the exchange rate tells you how many units of the quote currency you get for selling 1 unit of the base currency. In this example, you will receive 1.35520 when you sell 1 British pound. Most pairs are quoted with 5 decimal places, except the Japanese yen pairs with 3 decimal digits. So in this illustration, you see how the pound sterling versus the dollar is quoted with 5 decimal places, and then the dollar versus the Japanese yen is quoted with 3 decimal places. How does forex trading work? This is another important aspect that you have to understand. So let's look at it. The objective of forex trading is to exchange one currency for another in the expectation that the price will change. More specifically, that the currency you bought will increase in value compared to the one you sold. If you think the British economy will continue to do better than the US in terms of economic growth, you would execute a buy pound dollar order. Alright? By doing so, you have bought pounds in the expectation that they will rise versus the dollar. If you believe the British economy is slowing while the US economy remains strong, you would execute a sell pound dollar order. By doing so, you have sold the pounds in the expectation that they will depreciate against the US dollar. So this is it. Now, if you don't understand this, try and go back and take it again, because this is a very important aspect of the whole retail trader speculative perspective. Now, the forex trading session. The forex market is open 24 hours a day and about 5.5 days a week. With the whole 24-hour window, we have 4 main sessions. All right, it can even be broken down to 3 main sessions, putting Sydney and Tokyo session together. I mean the GMT time zone exactly, and then the markets open Sunday. So if you are on the same time zone, GMT plus or minus nothing, then the market open Sunday 9 p.m. GMT and closes on Friday 9 p.m. GMT. Okay, open and close times are based on local business hours. So for example, if it is Monday morning in Sydney and Tokyo, and then the markets open, we are going to see that reflection on the market as well, because it's a global market, the same market. And so in my GMT time zone, it will be 9 p.m. on a Sunday night. That is when the market will open. And then it will close when the New York market closes on Friday, and it will be Friday 9 p.m. in my perspective. From this illustration, you can see when the markets open and close. So you can see that the GMT time zone 9 p.m. is when the Sydney markets open. Then 2 hours later, the Tokyo market also starts. And see the finishing point, 5 a.m. Sydney market is going off, and then 7 a.m. the Tokyo market is also going off. Then London market starts 7 a.m. to 3 p.m. Now, depending on if they are observing daylight savings or not. All right, so please pay attention. And then we also have New York. Now, how do you know whether we are in daylight savings or standard time? Just Google it. So once you go on Google, you can see what time we are in currently. You have to understand which time zone you are in and what it means to the forex market. All right, one important thing you also have to note is that the most volatile section of the day is when you have two major markets lapping. For example, here is the London and then the New York market overlapping around 12 noon to 3 p.m. London is the economic hub of the whole world, and then New York is also the largest economy. So then if the two guys are open at the same time, the market is going to be extremely volatile. That is why this session is labeled red. All right, you can visit this website, forex.timezoneconverter.com. all right, and then you can check out what time it is in your country and what time it is in the forex market. Now, the bid, ask, and spread. All forex quotes are quoted with two prices, the bid and ask. Take note, the bid price is always lower than the ask. So from this illustration, we have two prices, a sell and then a buy price. So the first one, the sell price, is 1.34568 and then 1.34588. So the bid price is the price at which the market is prepared to buy from you, and then the ask price is the price at which the market is ready to sell to you, or the price the market will sell to you. That is the ask price. So looking at these two examples, the 1.34568 is the bid price. So it means if you are selling on that price. All right, that is why you see sell there. Now the spread. So bid price and ask price gives us the spread. So it is ask minus bid. So looking at these two prices, we have the bid price and ask price. When you subtract the bid price from the ask price, you are going to have 0.00020, and that is equal to 2 pips. The 2 pips is what you pay as fees for this transaction, and that goes to your broker when you execute the trade. Now, pips and pipette. A pip, short for point in percentage, is the unit of measurement to express the change in value between two currencies. A pip is usually the fourth decimal place of price quotes in general, but the second decimal place on the Japanese yen pair. So here we have 1.35524, and then the pip is the 2, and then we have pipette as the 4. So pipette is the fifth decimal place of every quote, and then the pip is the 4th. So on the Japanese yen pair, pipette is the 3rd decimal place, while the pip is the 2nd decimal place. So please take note. So let's look at an example on sterling, where sterling price is currently at 1.35524. Now sterling price goes up, and then the price is now at 1.35586. So how much pips have we moved? The pip difference between these two prices is 6.2 pips, or if you want to mention it in points, it will be 62 points. Now, leverage. Leverage is the use of borrowed funds to increase your trading position beyond what would be available from your actual deposit. Think of your broker as a bank who basically fronts you with $100,000 to buy currencies. Once your trade is closed, your loan is returned automatically and you keep the resulting profit. Wow. Now, leverage, however, can increase your gains, likewise your losses. Leverage is a double-edged sword. So it sounds nice that a broker is lending you money to trade with, and they don't charge you anything apart from the spread. You only take responsibility for your profit or loss. The same way it can increase your gains, the same way it can increase your losses. Make sure you understand the use of leverage. Example. Now, let's look at an example without leverage. So this trader is trading on a $1,000 account, and then the trader wants to buy euro against the dollar. Okay, so the trader executes the trade at 1.1305, and then the trade goes up to 1.1405. So euro dollar goes up by 10%. it means the trader automatically made 100 pips. And 100 pips without leverage in this example is equal to $10. So if the trade went against this trader, the trader would have lost $10. Now let's look at another example with leverage. So this time the leverage is 1:100. It means you can trade with 100,000 units. Account balance or margin is $1,000. So this trader also wants to buy euro dollar. The trader executes the trade and then euro dollar rises 10%, meaning 100 pips. The trader makes a return of $1,000 simply because the trader traded 100,000 units. All right. Now, in this same perspective, if the trade went against the trader for 100 pips, then this trader would have lost $1,000. And so it means that understanding the use of leverage or using leverage wisely can increase your gains. However, if you fail to use it wisely, it is going to kill your account. Lots. Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. A lot simply means your trade size. The lot is the unit of the base currency, as it is the basis for the buy or sell. This is a table for lot sizes, lots, and we have the standard lot, mini lot, and micro lot. So the standard lot, you control 100,000 units of the base currency, and then mini lot, you'll be controlling tens of thousands of units of the base currency, or the micro lot, you'll be controlling thousands of the base currency. So if it's euro dollar, you're talking about thousands of euros. If it is euro dollar and you want to trade standard lots, you're talking of hundreds of thousands of euros. All right. Okay. So to set the standard, micro, mini lot on your trading account, that is why you're going to select a volume of 1.0 or 1.5 for standard lots, or 2.0. That's two standards. Moving forward, we will learn how to decide which volume to trade on any account at any point in time so that we remain profitable. Now let's look at bulls versus bear. Bull versus bear. So we will be using this term frequently, and you want to understand and know what it means so you don't get lost when we are being bullish or bearish, right? You have to know what it means. So bull means something going up, the price is going up, the asset is going up, the stock is going up. And then bear means it's going down, right? So when you see the candles printing for the upward, it's bullish, the market is bullish. When you see it's printing downward, then the market is bearish. So bull also means buy, bear also means sell. Buy also means long, sell also means short. Bullish also means long, and then bearish also means short. Okay, so you have to understand this, and moving forward, the journey is going to be easy for you because you're not always going to say buy or sell. You're sometimes going to say bull or bear, or long or short, or bullish and bearish. Now, Forex orders. A Forex order is an order set to enter or exit a trade. That's Forex order. So let's look at some of the basic Forex orders. One of them is a market order. A market order is an order to buy or sell instantly at the best available price. Now, the pros to this type of order, there's guarantee that your trade will execute. So by all means, you are going to go in the trade. Now, the cons to this is that you might encounter slippage during fast moving markets. So for example, if there's a news release and you are trying to execute instantly, yes, then you might encounter slippage. What is slippage? So slippage occurs when a market order is executed at a different price. Okay, in this example, you want to execute your order at 1.2400. However, the price was executed, your order was executed at 1.2410. So this means there is a 10 pips slippage, right, on your order. Now, it could be that there is a news or something caused it, but whatever that caused it is part of trading, right? Unless it is a glitch from your broker's system, which we will be discussing later. Now, we also have pending orders. So we have the buy limit order and then the sell limit order. So the buy limit order is an order placed below the current market price. You are speculating that the price should drop so that it will give you a better price of entry before the price goes up, right? That is when you use the buy limit order. Now, when using the sell limit order, you think that the price is going to go down. However, you want to sell at a higher price before it starts going down. That is when you use the sell limit order. So the blue dot is representing the current market price. Then the red dash line is where you want to place your entry, and you're anticipating that the price is going down. That is for sell limit. Pros to this order is that order is executed at the price you want. Now the cons is that you might not get filled on the trade. So I've experienced this several times where the price moves close to my order, and because of some 1 or 2 pips difference, I don't get filled. So this is a con to this type of order, the buy limit or sell limit order. Then we have the stop order, the buy stop and then sell stop. So with a buy stop order is placed above the current market price, anticipating that the price will sort of break some structure and continue to go in that direction. Once the price breaks the structure and continue to go up, then your buy stop order is triggered and then you'll be in profit, right? And then a sell stop order. So sell stop order is when you anticipating that the price will break a certain support structure and continue to fall. So you set a sell stop order so that your order gets triggered at that price and then continue to go in your anticipated direction. Now the pros to this is that it is useful for breakout trading. So if you're going to be trading a breakout strategy, then this type of order will be your basic order type and what you'll be using most of the time. Now the cons is that move might be a false breakout. So if you use a stop loss order most of the time, you might be catching false breakout, and that is why you're going to be using a stop loss to prevent your account from blowing. Now, what's a stop loss? Stop loss, also known as SL, is a predetermined price to exit a trade to limit your loss or to protect a portion of existing profits in an open position. We are going to go to the practical aspect of this and see how this works. So the pros to this is it protects your downside, and then the cons, it might get stopped prematurely. So we will look at how not to get stopped prematurely, or how you can get stopped prematurely on the charts. Now, a take profit order, a pre-calculated price that is set to automatically execute a position to secure profit when price reaches the specified threshold. Now, let's look at this illustration. When buying, your take profit is above your entry, and then your stop loss is below your entry. And then when selling, your take profit is below your entry, and then your stop loss is above your entry. So most beginner traders get confused with this. So you can take a pause, save this illustration and study it. Now let's look at brokers. The first broker is a financial service company that provides traders access to a platform for buying and selling foreign currencies. In forex trading, the broker operates as a middleman between you, the trader, and the market. So back to the structure we looked at. So you can see where the broker is seated, and the broker is simply there to connect us retail forex traders who are speculating on prices to the main market where the banks play. So we have two types of brokers. Basically, we have the dealing desk and then the no dealing desk broker. And on the side of the no dealing desk broker, we have the ECN. ECN, also known as Electronic Communication Network, is a forex broker that connects buy and sell orders to various market participants, whereas the market makers takes the other side of your trade. Okay, so let's look at some factors to consider when choosing a broker. regulation and security. So you want to be sure, or you want to check whether your broker is regulated in the state where they belong, right? And however, regulation that is not the ultimate reason why you will work with a certain broker. 90% of brokers out there are regulated. Then security in terms of their website protection, you want to be sure that they are protected. You want to be sure that the broker is using a segregated account, which is different from the trading platform. So an account where your money is held, of which you will transfer some of your holdings into your trading. So your trading account should be different from your main account where your money is held. That way you are sure of some level of security on your account. Also, you are looking at transaction costs. So some brokers charge way too much, but now there's competition. So even though there are some brokers that still have a little high spread, some brokers are really having very, very tight spread because they understand that traders want to be going after tight spread. But that is still not the ultimate reason for you to choose a certain broker. You have to consider all other factors and weigh them out. All right, not just one factor, but all other factors. Now, deposit and withdrawal. So with some brokers, when you deposit money, it's gone and it's in your account. You can see it. Yes, it's not going to go anywhere. It's going to be in your account. However, the broker should not make withdrawal difficult for you. For example, you issue a withdrawal, that broker has no reason not to pay you. The broker must be able to pay you within their set time. So the broker is going to tell you when you make withdrawal how long you are going to receive it. All right, and then they should make sure you receive it within that period of time. Okay, so if a broker is going to give you stories like we have backlog, so come back another day, that's no excuse not to pay you, man. Now, trading platform. Okay, so you want to be able to connect MT4 with this broker, or the broker should have MT4, MT5, and probably other trading applications on their website. So for instance, you should be able to download MT4, MT5 directly from the broker's website. That means that the MetaTrader company is working with the broker, right? Yeah, because it's not easy for the brokers these days to get listed with MetaTrader. So they'll go through a series of verification process before the MetaTrader company will grant access to the broker to be able to use their platform for trading. Now, execution. You want your orders to be filled at the exact same price or just some few pips difference or pipette difference if there is slippage. All right, so your execution also counts on choosing which broker to work with. So you want to get your execution as fast as possible if you have no network issues. All right, then customer support. You can have issues at any point in time with your account, and then reaching the customer support of the broker should be an easy thing to do. It shouldn't be difficult at all, or the customer support should be available at least 247 or 245 once the market is open. So with these factors, you'll be able to filter down to which broker to work with. Okay, how to open an account. Before you open an account, you have to choose a broker. You have to decide which broker you want to work with. So you can sign up with any of the brokers' links in the description. 2, fill up your personal information such as date of birth, email, address, phone number, and etc. And then next, submission of document for verification. So you're going to submit your document, which is your ID to prove your identity. And it should be a government issued ID card or traveling passport. Some brokers accept driver's license. Another document you need is either a bank statement or an utility bill that has your name and address information on it. So you're going to use the same address that you use has to reflect on your bank statement or utility bill. All right. The easiest one is the bank statement. So you can easily walk into the bank, open an account, put your address on the account, and then go back and print the statement. All right, pick account type and leverage is the next step. So you are now setting the account you're going to trade with. Remember, you don't have to go for a big leverage like 1:2,000, 1:1,000. Nope, that is not what you need. Now, time to fund account. So this is where you're going to fund account, and then they will send you account login information. With this login information, you can set up your trading account and start trading live. How newbies choose a broker. High leverage. So some newbies, once they come into trading and they hear a high leverage, like a broker offering 1:2,000, 1:3,000, 1:1,000, that is the broker they like. Or 1:500, that is still high. So if you understand leverage, like we looked at in the example previously, then you will know that you don't need a very big leverage to decide on which broker to choose. No. Low spread. Okay, so there are times that you also see new traders jumping from one broker to the other because they heard that broker is offering a very tight spread. All right. Or broker B is offering a tighter spread than broker A. So they'll be jumping from one broker to the other, forgetting that that is not going to do the magic. That is not what is going to make you the money. So they'll be looking in the wrong direction. They think it's all about success, so they have to be successful by any broker they're working with. Lowest capital requirement. Okay, so newbie traders also choose broker based on which broker is asking for the lowest capital. For example, they can say that, oh, this broker is taking $1, $5, or as little as $10. Like, hello, so you're going to this broker? The broker is not being truthful. What are you going to do with $1? No. Even a broker that says come and deposit $1, you should not trust the broker. Why is the broker asking you to deposit that little? Does the broker think you can make a good trade with $1 or $5 or $10? Think about it, and then choose a broker because they are simply asking you to deposit that penny. Newbies go after famous brokers, right? Now, famous brokers are famous because they are good at marketing, but being good at marketing doesn't guarantee quality work. So you don't want to chase a famous broker over quality. Otherwise, it will be like you are chasing quantity over quality. All right. So guys, don't choose a broker based on any of these four things. Now, this happens because most newbie traders come in with one mindset: becoming successful. Here comes the end of section B, guys. So you can take another break if you want. If not, let's go on with section C. Okay, guys, welcome to section C. In this section, we will be looking at the Forex market analysis, types of Forex charts, the candlesticks, support and resistance, risk management, risk to reward, position sizing, types of traders, and then the time frame. All right, let's go. So the Forex market analysis. Forex market analysis is the study to determine whether to buy, sell, or wait when trading a currency pair. So here it is three things: you buy, sell, or wait. Now, one thing traders have to understand, or beginner traders have to understand before coming into trading, is that waiting is part of trading. Not doing nothing is part of trading. Trading is not about executing a buy and a sell order or getting in and out of a trade. All right. Now, this is also a way to read and anticipate where the market or price is going to be next. All right. So while waiting, you are waiting to see what the price will do next before you make a decision. There are three types of Forex market analysis. These are the technical analysis, fundamental analysis, and sentimental analysis. Normally, these works hand in hand, but we will be looking at the two main types, which is the technical analysis and fundamental analysis. All right. And sentiment is pretty simple. It's just a position that other traders are holding, and it means that they are either technical traders or fundamental traders. That makes up the sentiment. All right. But let's move on and look at what technical analysis is. So technical analysis is the study of historical price action in order to identify patterns and determine probabilities in future movement in the market through the use of the chart and other tools. The main reason for using technical analysis is that theoretically all current market information is reflected in the price. Technical analysts look for similar patterns that are formed in the past and will form trade ideas believing that price will act the same way that it did before. The past data can help you spot trend lines and patterns, which could help you find some great trading opportunities. Now, the fundamental analysis. So, fundamental analysis is the process of breaking down the impact of economic, social, and political factors that may affect the supply and demand of a currency. You have to understand the reason of why and how certain events like an increase in unemployment rate affect a country's economy and monetary policy, which ultimately affects the level of demand for its currency. Now, some economic data that you will be watching out for are the retail sales, the interest rate decision by the central bank, employment data or unemployment rate, consumer price index, the CPI, and then we have the gross domestic product, and many others. There are many others, but these are few examples that you'll be looking at. So you need to understand these data and how they are going to affect the economy and how that is translated in its currency, as mentioned. Now, when you download any of these economic calendars onto your phone, this is how it's going to appear. Then you have to filter down the noise by removing the low impact and mid impact. So to the right, you can see that it has some red labeled high impact, medium labeled yellow, low labeled as green. Now you want to remove at least the low and medium, or just low, and then you will leave the high and medium. However, I like to focus on the high impact news, so I filtered down all other noise except holidays. At least holiday, just for you to know that nothing is happening on that day. No, it's a bank holiday, so nothing is going to happen, or you don't expect much on that currency or session. All right, so, and the left is economic calendar from investing.com. So for them, they represent the impact with bull heads. All right, so you want to filter down the bull head, leaving the 3 bull heads. So 3 bull head represents high impact news with the investing.com app economic calendar. Also, you want to filter down to just the 8 major currencies. All right, you also want to visit forexfactory.com, and you're going to get news, breaking news, and then you also see the economic calendar there. So there's another place you can find news. All right, 3 types of Forex charts. There are quite a number of Forex charts, but you'll be looking at the 3 most popular types of Forex charts. These are the line chart, bar chart, and then a candlestick chart. So let's look at the line chart. A line chart simply draws a line from one closing price to the next closing price. This chart only depicts the closing or the last price of the session. Now the bar chart. A bar chart shows the opening and closing prices as well as the highs and lows. The bottom of the vertical bar indicates the lowest traded price for the time period, while the top of the bar indicates the highest price. The vertical bar itself indicates the currency's pair trading range as a whole. The left horizontal hash is the opening price, and the right horizontal hash is the closing price. Now the candlestick chart. So candlesticks also indicates the high to low range with a vertical line known as the shadow or wick. With candlesticks, the body in the middle indicates the range between the opening and closing price. Now, if the price closes below the open, it means a bear candlestick. Here it is represented by black or the red. Now, if the price closes higher than the open, then it is a bull candlestick. It is represented by white or green. Advantages of candlestick charts. It is easy to determine the current state of the market at a glance. You can see the direction of the market more easily. You are able to identify chart patterns quickly, Easy to identify market turning point. How to read candlestick charts. So, the appearance of the candlestick's body and its shadow potentially provide a lot of information about the state of the market and what is expected. Long bodies indicate strong buying or selling. The longer the body is, the more intense the buying or selling pressure. This means that either buyers or sellers were strong and took control. Now, short bodies. So short bodies imply very little buying or selling activity. The longer the candlestick, the further the close is away from the open. The upper and lower shadows on Japanese candlesticks provide important clues about the trading session. Candlesticks with long shadows shows that the trading action occur well past the open and close. Short shadows indicate that most of the trading action was confined near the open and close. If a candlestick has a long upper shadow and short lower shadow, this means that buyers bid the price higher, but sellers came in and drove the price back to end the session back near its open price. If a candlestick has a long lower shadow and short upper shadow, it means that sellers forced price lower, but buyers came in and drove price back up to end the session back near its open price. All right, so this is how easy it is to read some of these candlesticks and interpret them. So at least we looked at the long body, short body, long shadow, and short shadow. So at this point, interpreting this when you see them on a chart is going to be pretty much easier, right? Okay, so let's look at some basic candlestick patterns. From this chart, you can see some basic candlestick patterns, right? Now, it's not about the name, all right? A name is just an identity. But what matters is what it's made of or what it means. So the meaning to the name is more important. I'm saying this because there are other names for the same kind of patterns. So people kind of fight over names like, this is not supposed to be called the hammer. It is called pin bar. What is the difference? Don't go arguing over the name of the candlestick. However, try and get what it means, because that is where the money is. The money is not in the name. The money is in what is expected of it. Okay, so we have like spinning top, doji, maribozu, hammers, and etc., shooting star, and etc., right? Good. So take a pause, take a short, or put this information in your notebook because you are going to need it moving forward. All right, we are going to get more technical with this, so grab it up. Now we have the double candlestick patterns also, whereby we have the bullish engulfing and then tweezer tops and tweezer bottoms. So bullish engulfing, bearish engulfing, tweezer tops and tweezer bottoms. So once you're looking at a bullish engulfing, it should tell you something is happening. Every pattern you're looking at should communicate some information to you. We'll go into details on these and how to interpret them. Triple candlestick patterns, we have what we call morning star, evening star, white soldiers, black crows, 3 inside up or 3 inside down. Like I said, the meaning is more important than the name, so focus on what it means. So morning star simply is a signal of a bullish expectation, right? Signal of a bullish expectation. And evening star is a signal of a bearish expectation. So it goes on and on and on. Just take a shot and make a note so that once you see them, you know what it means. All right, good. Now let's look at forex support and resistance. So support occurs when falling price stop, change direction, and begin to rise. Support is often viewed as a floor, which is supporting or holding up prices. Then resistance is a price level where rising prices stop, change direction, and begin to fall. Resistance is often viewed as a ceiling, keeping price from rising higher. All right, so from this illustration, you can see the resistance point are the points where the price paused on an upward move and started to go down, and then support is where the price stopped on a downward move and started going up. So that's support and resistance basically. Support and resistance level are not exact numbers. You should think of support and resistance more of as zones. Support or resistance level is broken if the market closed past that level. However, this is not always the case. You can also use line charts to plot support and resistance levels, right? Since it only show you the closing price, while candlestick at the extreme highs and lows. Interesting tips about support and resistance. So when the price passes through resistance, that resistance could potentially become support. The more often price tests a level of resistance or support without breaking it, the stronger the area of resistance or support is. When a support or resistance level breaks, the strength of the follow-through move depends on how strongly the broken support or resistance had been holding. Risk management. Now, risk management is a very important topic because this is where your success lies. Now, if you know how to manage your trade properly, then you are going to become a successful trader. So you have to apply proper risk management on your trading. In fact, risk management is key to becoming a successful trader. So Forex risk management comprises individual actions that allow traders to protect their capital, right? Now, if you're in a business and you can't protect your capital, where is the business going to go? Uptrend or downtrend? We all know. It's also the ability to encounter a series of losses without blowing up your trading account. So losses are part of trading. Losing is inevitable, all right? And being able to control your losses so you don't blow your account is key to becoming a successful trader. You can have a winning trading strategy, but without proper risk management, you will find troubles with being consistent. Risk to reward ratio. The risk to reward ratio is a metric that you will use to calculate how much you are risking in the market versus how much you will make. The ratio helps assess the expected profit and loss of a given trade. Risk to reward ratio is also like a key instrument in risk management. So it's all under risk management, all right? So pay attention to this and make sure you understand it. So for example, you are risking 1% on a trade and then you are targeting 3%. That gives you a 1:3 risk to reward. Your risk is identified always, all right? But your reward depends on the market condition. So when I'm going in a trade, the first thing I have on my mind is my risk. How much I am prepared to risk on the trade versus how much I'm going to make. I don't even know that before I take the trade, right? So I follow price action to determine whether I want to take profit or not. After closing the trade, then I will know whether the trade was a 1:1, 1:2, or 1:3, because I can write one trade that will go for 20%, 30%, or 10%, right? So I don't predetermine that I want to make 20% on this trade. No, I follow the trend. And I'm going to teach you how to do this, all right? It's just a little trick. So on this other example is pips. So if you're risking 20 pips and targeting 20 pips, meaning it's a 1:1. So you can risk 20 pips and target 60 pips, which means 1:3 reward ratio. Is the same thing, right? So you coming in the trade, you have to know how you're going to determine your risk to reward, all right? Are you going to use my style that follows price action, or are you going to predetermine that on every trade you take, you're going to take 1:1, meaning you are targeting 20 pips if you are risking 20 pips, or you are targeting 40 pips if you are risking 20 pips, meaning 1:2. Now these numbers will vary. I'm only citing an example with this. It's not all the case that you'll be risking 20 pips. No, 20 pips is just an example. Sometimes your trade could be in a 50 pips risk, and it could still mean a 1% risk. If you want to risk 1%, it has to be 1% all your trades on that account. You don't risk 1% today, tomorrow risk 0.5%, another day risk 2%. No. Then it's better you don't apply any risk management rule. All right. However, if you want to become a successful trader, you have to pay attention to risk to reward and stick to, if you are using 1%, stick to 1%. All right. If you are risking 0.5%, stick to 0.5%. But I will not advise you to go for 2% or more. All right. Good. Now let's look at an example of risk to reward ratio, how this can impact in a trader's life or account. Okay, so let's look at an example with trader J and trader X. Now, these two traders got a capital of $1,000, right, each. Now, their win rate is 50%. Risk to reward is 1:2. Trader J decides he wants to risk $250 per trade on a $1,000 account. That is 25% risk per trade. And then trader X decides he wants to risk $20 per trade. So that is what, 2% per trade. Now let's see how the journey is going to go for them. So these guys are like from the same community, and then they are going to take the same kind of trade because they are learning from the same mentor, right? So probably the mentor is doing the call. So let's see what will happen in that trading community in few days ahead. Trade number 1 is called, and what happened? Oh, a loss. So trade number 1, there is a loss, and then trader J loses $250 down to $750, and then trader X loses $20 and down with a balance of $980. Day 2, another loss. Oh man, this is not looking nice. Okay, so trader J is down half of his account, and then trader X is down with another $20. Let's see how this is gonna go. So if they win the next trade, trader J is going to be up back to $1,000. Likewise, trader X. All right, so let's go. Oh, but it's a loss. They are down again. Trader J is down another $250, and his balance is now $250. Trader X is down another $20 with balance at $940. We have about 5 more trades to go. Is the next trade going to be a winner or a loser? Let's take the trade and find out. Trade has been taken. Result, another loss. Oh my God. Trader J is down to 0. Margin call. Now trader X is down with another -20, and balance is now at $920. Because trader J is down to nothing, he cannot take another trade unless he make another deposit. However, the 5th trade is being called. Now trader J cannot take the trade. But what is the outcome of trade number 5? It's a winner. Trader J could not take the trade because he's blown his account. But trader X is up $40 and account is now back at $960. Trade number 6 has been called. What will be the outcome of the trade? Here we go. And again, another winner. Trader J still couldn't take the trade. Now trader X is up back to $1,000. He won another $40 on this trade number 6 because he's using a 1:2 risk to reward ratio. Trade number 7. Here we go, another win. Trade number 8. Trade number 8 is also a winner, but trader J could not take that trade, and trader X is up $80. Wow. So trader J made -100%. He blew his account on the 4th trade because he was risking 25% of his account. Losing streaks will come, winning streaks will come, but it is how you control your losses that will bring you to the winning days and out of the loss. Because when the losing streak come, you need to still be able to protect your account, and this is risk management. And now trader X made 8% of his capital, and that is good. Even if it's a month's gain, 8% is good. Now calculate your risk and reward on percentage. That is the best, so that you can trade on any account. As a beginner, you will not be able to trade on a 50k real account, 100k real account, knowing that it's 100k, because there are emotions involved when you are trading on a big account, especially when you can see that your losses are growing bigger and bigger. All right. Now position sizing. So how can we determine how to risk 1% per trade? This is position sizing for you. Position sizing is setting the correct amount of units to buy or sell a currency pair to limit your risk within your comfort level. Your position size or trade size is more important than your entry and exit point when trading Forex. You can have the best Forex strategy in the world, but if your trade size is too big or small, you either take on too much or too little risk. Position sizing is key, as risking too much can blow up your trading account quickly. You will need a calculator. You can download Forex calculators from Play Store, get Steno or my FX Book app from App Store or Play Store. We also have the web version from babypips.com/tools/position size calculator, and also we have my fxbook.com/forex calculators and stuff. So you can check out this link if you want to try the web version. Now let's move on and look at an example with the Forex calculators app. When you download the Forex calculators app, this is how it's going to appear. And for informations you need to calculate your position size is 1, the account balance; 2, the currency pair you're trading; 3, you need to identify risk per trade, then stop loss in pips. So from where you are doing your technical analysis, you identify the stop loss in pips, which is the difference between your entry point and then stop loss point. That will give you your stop loss in pips. All right, so in this example we will look at let's look at an example with an account balance of $1,500. Then the currency pair we want to trade is euro-dollar. Now the risk per trade is 1%. We want to risk 1% on this account, and then stop loss in pips after our analysis on the chart is we decided we want to risk 25 pips. Okay, so how can we decide we want to risk 1%? Now you input this information on the position size calculator. The account balance $1,500, the stop loss in pips 25, and then the risk per trade is 1%. Then you hit calculate, and here we go. So the position size calculator is telling us that if we want to risk an amount of $15, which is 1% of the account balance, then we should take this trade with a lot size of 0.06. So this is 6 micros, and we have to make sure that once you're going to enter this trade 0.06, your stop loss should be exactly 25 pips from your entry point to your exit point. Let's look at the 4 main types of Forex traders. You have to identify yourself, you have to know yourself and know which category you fall by knowing the trading style that best suits you. All right, if I'm a scalper, doesn't mean automatically you too have to become a scalper because you are learning from me. If I'm a day trader, doesn't mean automatically you become a day trader because you are learning from me. No, whatever trading style I'm doing depends on how much time I have to be able to come to the chart and go, or which days of the week I'll be available to do any analysis. So all these count, and these tells the type of trader you can be. So you have to look at yourself and answer these basic questions. Now let's look at number 1, scalpers. So scalpers hold on to trades for few seconds to few minutes at the most. The main objective is to grab very small amount of pips as many times as they can throughout the busiest times of the day. So they try to grab very small amount of pips as many times as possible. In the Forex trading session, we looked at which time is the most volatile session or busiest time of the day. Was the London overlapping the New York session, right? That's the busiest hour. So that's when you get scalpers going to work, right? And then coming out with either a profit or a loss. And they focus normally on the lower time frames. Scalpers look at 1 hour or 30 minutes time frame, or 15 minutes time frame, 5 minutes time frame, and even 1 minute time frame, depending on the strategies they are applying. Now, day traders usually pick size at the beginning of the day, acting on their biases and then finishing the day with either a profit or a loss. day traders do not hold their trades overnight. Now, swing traders also hold on to trades for several days to weeks. These types of traders also base their analysis on higher time frames to make sound trading decisions, right? So they hold their trades for a long time. So when analyzing the market, in fact, the minimum point they can get is even 4 hour or 1 hour for entries, right? But then they be focusing the analysis on weekly chart, daily chart, the 4-hour chart, and maybe 1 hour. Now, position traders. So position traders are those that hold trades that last for several weeks, months, or even years. They mostly factor fundamental themes when analyzing the market. So they want to know where the interest rate is going to make that decision. So they mostly factor fundamental themes such as interest rate, GDP, unemployment, and etc. All right. But it doesn't mean that as a scalper or day trader, you cannot factor fundamentals. It also depends on which strategy you are trading. All right. Good. Now, the chart time frame. So I've mentioned time frame, and if you're a beginner, you'll be confused. What is he talking about? All right, so this is simple. A time frame is referred to the period of time in which trading takes place, or the period in which the candle open and close. All right, so up here we have examples such as 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, 1 hour time frame, 4 hour time frame, daily time frame, weekly time frame, and even monthly time frame, all right, and more. As you can see, this chart is a daily time frame, right, of the British pound versus the Japanese yen. Each candle you are seeing is 24-hour period. Every candlestick open and close within 1 day. So if you change the time frame to 4-hour time frame, then it means every candlestick you will be seeing on the chart open and close within 4 hours. If you go down to 1 hour, the same thing. So you can just open the chart and look at it. Try to change the time frame, and then you will see what's going to happen. Okay, when you go down to 1 minute, you realize that after every 1 minute, a new candle is opening. 1 minute, na candle bako. Typically, Forex time frames will be measured in minutes, hours, days, or weeks. All right. Multi-time frame analysis is the process of viewing the same currency pair under different time frames. So I mentioned top-down analysis. So that's what it means by multi-time frame analysis, whereby you'll be analyzing the market starting from the wider time frame perspective and then moving down to the smallest time frame where you want to pick an entry. Usually the larger time frame is used to establish a longer term trend, while a shorter time frame is used to spot ideal entries into the market. Okay guys, here come the end of section C. Congratulations for making it to the end of this beginner's guide part 1. Now the part 2 is going to come in subsequent 10 to 15 minute videos, and I bet you don't want to miss out because it's about to get practical. I'm going to share my trading strategies with you, how to use the MetaTrader app, how to use TradingView charts to analyze the market, how to do everything that you need to do to become a profitable trader. Now I'm going to share everything with you. So you know what? Join our Telegram page via the link in the description, and also subscribe to this channel and turn up the notification so you don't miss out on future content. We'll be discussing more on Forex trading and cryptocurrencies, and you don't want to miss out.